Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Today, we're sharing 3 stories. First, a synchronized plunge in government bonds across the UK, France, and Germany is rattling markets. We'll explore why gold is hitting record highs and what high-frequency trading algorithms have to do with the chaos. Second, we'll unpack how a shouting match involving tennis player Taylor Townsend at the US Open exposed a $284 billion firm called Blue Owl and its plan to sell you risky 2 and 20 investments. And third, shares of Constellation brands are plunging after the maker of Modelo and Corona slashed its outlook. CEO Bill Newlands is blaming a sales drop among Hispanic consumers, the group that makes up one half their business. A September shock is sending tremors through global markets. In the UK, yields on 30-year government bonds just hit their highest mark since 1998. France, a 16-year high. And in Germany, a 14-year high. Bond prices are in a freefall as investors grow deeply nervous about the state of government finances worldwide. So the thing is, a significant portion of this sharp, synchronized movement is likely amplified by technology. We're talking about high-frequency trading algorithms that can react almost instantly to news and market signals. When thousands of these algorithms hit the sell button at once, it creates a feedback loop, turning a regular sell-off into a dramatic plunge, much like the 2010 flash crash. One analyst at Societe Generale calls it the pain trade that is seamlessly carried over from August into September. That pain is spreading. The Dow, the S&P 500, and the NASDAQ are all in the red as the turmoil has equity investors on high alert. But while stocks and bonds get hammered, a tidal wave of cash is flooding into safe havens. Gold just surged to its highest level on record, breaking $3,536 an ounce. Interestingly enough, in a world of digital gold like Bitcoin, investors are still flocking to the physical metal. During a real crisis, gold has a long proven history as a stable store of value, and research shows it tends to move opposite to stocks during financial stress. Bitcoin, on the other hand, has often moved with riskier assets, making it less of a true safe haven for institutional money. Silver also just hit a 14-year high, and the US dollar is strengthening as capital flees the chaos. Driving this global sell-off is a perfect storm of fiscal jitters. In the US, an appeals court just ruled that most of the Trump-era tariffs are illegal, creating massive uncertainty. This kind of prolonged instability has, after all, permanently changed how global companies operate. It's not just about moving factories anymore. To survive, tech firms are deploying AI to predict disruptions and building digital twins, virtual copies of their supply chains to stress test for weak spots. It's a whole new level of strategic defense. Meanwhile, US manufacturing has now contracted for a 6th straight month, yet we're seeing a fascinating countercurrent, an AI spending boom. Companies are pouring money into predictive maintenance and factory automation. This investment in intellectual property is growing at its fastest pace in 4 years, acting as a buffer and showing how some industries are building resilience. And the political instability is spreading. France's prime minister is facing a confidence vote. The UK's finance minister is expected to raise taxes. And in Japan, a key aide to the prime minister has suddenly resigned, and the pressure might not be letting up, as one analyst warns that a flurry of new government debt issuance threatens to exacerbate the global sell-off. Ultimately, the sheer scale of government debt is at the heart of this crisis. On the horizon, some governments are exploring high-tech solutions like tokenized blockchain-based bonds to make trading debt faster and cheaper. It's still experimental, but it shows even central banks are looking for a technological way out of this trap. It leaves everyone wondering, is this just a market correction or the start of a much larger financial reckoning? From chaos in the public markets to a secret world of finance being thrust into the spotlight, a viral shouting match at the US, Open just accidentally blew the lid off one of Wall Street's most secretive industries. As cameras zoomed in on tennis player Taylor Townsend's heated exchange, viewers saw a logo few recognized: Blue Owl. So who is Blue Owl? A massive $284 billion asset management firm, and they're backing nearly 100 athletes in a bold marketing play. This isn't just about sports. It's part of a massive power shift as the 50-year-old world of alternative assets comes out of the shadows. For decades, advertising was forbidden for these firms. But since the 2012 Jobs Act loosened restrictions, the floodgates have opened. The industry's top 7 players now manage a staggering $1.7 trillion in retail-focused funds, up 21% in just 1 year. This explosion isn't just because of a law change. It's being powered by a whole new technological infrastructure. Think of it as the fintech plumbing for Wall Street. Companies like iCapital and K's have built platforms that digitize complex investments, essentially building the Amazon.com for assets once only available to billionaires. But here's where it gets interesting. According to one person with knowledge of these private discussions, the phrase velvet rope is used constantly. Firms want to keep their exclusive institutional investors happy while capturing a growing share of retail money. As one marketing expert put it, the high net worth community is now the it girl for these private market giants. To understand this branding paradox, we can look at high fashion. Think Cartier or Louis Vuitton. They protect their exclusive image, but also want to sell more. So they create masstige products, a mix of mass and prestige, like mid-priced accessories to let new customers in without diluting the brand. That's exactly the tightrope these financial firms are trying to walk. Blue Owl's strategy is surgically precise. For about $20,000 a patch, the firm sponsors the opponents of top-seeded players, betting on getting maximum camera time for a fraction of traditional ad costs. They're spending about $2 million this year on that program. Believe it or not, it's the Moneyball of sports sponsorship. They are using data analytics to find massively undervalued assets, not the player, but the screen time the player gets when facing a superstar. But this strategy presents a fascinating duality. On one side, it's a data-driven way to get maximum return on investment. On the other, it provides a crucial financial lifeline to lower-ranked athletes for whom life outside the top 50 is a brutal grind. For them, this sponsorship is a paycheck that keeps them in the game. This is the new arms race in finance. Blackstone is using social media. Apollo Global has partnered with a PGA Tour golfer. The secret world of high finance is breaking down its walls. And this push to democratize finance brings both potential opportunities and comes with inherent risks for the everyday investor. We're talking about private equity and other complex assets that lock your money up for years and often use a 2 and 20 fee model, a 2% management fee plus 20% of your profits. The question now is, what happens when that velvet rope is gone for good? Speaking of brands walking a tightrope with their audience, shares of Constellation brands, the titan behind Modelo and Corona, just took a nosedive, falling about 8% in pre-market trading. The reason? The company just slashed its full fiscal year outlook. The numbers are staggering. Constellation reversed its forecast for organic net sales from 1% growth to a decline of 4 to 6%. Free cash flow estimates were also cut from a high of $1.6 billion down to $1.3 billion. CEO Bill Newlands cited a challenging macroeconomic environment. But to understand these challenges, you have to know that massive companies like Constellation don't just guess, they use incredibly sophisticated predictive analytics. They feed machine learning algorithms with huge amounts of data, not just sales, but real-time info like social media sentiment and news events. This allows them to draw a direct line between something like a political speech and a potential drop in sales. This is where the situation takes a more complex turn. The company is pointing to a significant drop in demand from one critical group, Hispanic consumers. This is a 5-alarm fire for the brewer because that demographic accounts for approximately half of its total beer sales. This vulnerability highlights a concept in the business world known as demographic concentration risk. When you rely so heavily on one group, any shift in their behavior can create massive volatility. To put this in perspective, successful brands like Chobani de-risk by diversifying, expanding from breakfast yogurt to products for different times of day to reach a wider audience. That's the kind of move that protects a company from the exact situation Constellation is in now. The company has previously said this pullback is caused by this consumer group's concerns about immigration policies and potential job losses linked to Donald Trump. When we place Modelo's deep-rooted brand identity alongside the community's current challenges, the contradiction becomes clear. It highlights the authenticity marketing paradox. A brand's powerful connection to a culture is a double-edged sword. It creates a unique vulnerability when that community faces hardship. Getting this right is incredibly difficult, as studies show a staggering 80% of multicultural marketing campaigns fail to resonate. This isn't a small dip. It's a fundamental challenge to their business model. This leaves a crucial strategic question. When a core customer base that makes up half your business pulls back for political reasons, how does a company navigate that storm? And as Modelo falters, it creates a vacuum. So where is that spending going? Real-time data shows a fascinating shift. Some market shares going to other Mexican imports, but what's really interesting is the broader trend. We're seeing consumers, especially younger ones, moving out of traditional beer altogether, exploring non-alcoholic beers, hard seltzers, and canned cocktails. This signals a potential transformation for the entire beverage industry.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.